afternoon for this CSG-South webinar entitled Wind Pool Insurance Strategies from SLC States. I am Sujit Kanagaretna, Senior Fiscal Analyst for the Southern Legislative Conference, the Southern Office of the Council of State Governments. I want to thank our moderator and distinguished panel for setting aside time from their busy schedules to address this important topic. I also want to thank Carrie Abner in CSG's Lexington office for taking care of all the logistics related to this webinar. Thank you, Carrie. Before I hand off to our moderator, Representative Bob Dameron, Kentucky House of Representatives, I'd like to take care of a few housekeeping items. You are all in listen-only mode. If you wish to ask a question, please use the question box on your GoToWebinar toolbar. You may type in a question at any time during the webinar, and we will get to them at the end. We will be recording this webinar and posting it later on the CSG Knowledge Center website, knowledgecenter.csg.org, and the SLC website, slcatlanta.org. We will hear from our distinguished panelists in the following order. First, Professor David C. Marlett, Chair of the Department of Finance, Banking, and Insurance at Appalachian State University in Boone, North Carolina. He will be followed by Representative Stephen McMillan, Chair of the County and Municipal Government Committee in the Alabama House of Representatives, and finally, Representative Todd Hunter, Chair of the Calendars Committee in the Texas House of Representatives. Representative Dameron, over to you.
Thank you, Susan, and welcome everybody to this webinar on a very, very important issue to not only southern states, which Kentucky's one, but I think to a lot of states. In recent years, as we all know, states in CSG-South's area, as well as the nation as a whole, have been exposed to significant risk due to hurricanes and tornadoes. These immense storms have caused immeasurable damage in terms of the loss of human life, billions of dollars in economic cost. As a result, homeowners face unenviable challenges of not only securing insurance for their homes and property in affected areas, but also dealing with steep premium increases. In response to this unfortunate development, a number of southern states are continuing to devise measures to provide homeowners with wind pool insurance coverage at affordable rates. The webinar today will cover what some of these measures are, the broad trends associated with wind pool insurance, best practices, and how international developments impact premiums here in the United States. And I'll close my opening statement with the fact that even though Kentucky is not in Tornado Alley, nor are we on the coast, we have also suffered severely from tornadoes over the last 4 or 5 years, with some of our communities still struggling to rebuild from those problems. And the state has tried to reach out and help, but with dwindling dollars available to all states, we know that money and resources are certainly scarce, especially at a time of a catastrophe. So at this point in time, we'll go with Professor David Marlett, who Susan has already read a little bit about his bio, and we'll hear from Professor Marlett. Professor Marlett?
Thank you. Good afternoon. I appreciate the opportunity to present to you all. This is an area that's been my main source of research for the last couple decades now. I did work in Florida as an underwriter for an insurance company back in the 90s, and was able to witness the market change pre and post Hurricane Andrew in '92. That was really the turning point for this issue of wind pools and residual markets. Even back then, we knew rates were too low. What we did not know was our exposure, that even with the top companies at that time, really didn't have a very good idea of what the exposure was, and didn't have very good prediction tools. This was my dissertation topic in college, and been working on it ever since grad school. So if you go back quickly to the 90s, after Hurricane Andrew, the legislators and regulators in Florida scrambled to put together some market solutions, trying to piece together a market for property owners. And attempted to get some rate increases because, again, people did know rates were too low, but they were balancing that against not wanting to slow economic development along the coast, and by holding down the rates to encourage development, that actually made the problems worse over time because we increased the number of homes built in exposed regions, and then we get to the housing boom, and it increased the exposure even greater. Slide 2, please. One thing to clear up, I guess the teacher side of me, we need to clarify the term a little bit. Wind pool probably isn't the right term. We should be using residual markets. Residual markets include wind pools, also include beach plans, fair plans, citizens, JUAs. So if you hear all those terms, they're typically referred to as residual markets. They're formed slightly differently. Each state has a somewhat different model, but conceptually they're all the markets of last resort. These markets should not compete with insurance companies in terms of price or coverage. They should by no means be the market of choice for the consumer. They should be the market of last resort. We also have the standard insurance market. This is where you would see Travelers, State Farm, Nationwide, Farm Bureau, the companies we've all heard of. This is typically called the standard market. It might also be called the competitive market, the admitted market. I'll call it the standard market today. And the standard market's doing very well. The first half results for 2013 just came out. Earnings were very strong, improved over last year. There's a record amount of policyholder surplus, over $600 billion. The combined ratio, which measures the amount of money that goes out versus comes in, was less than 100, down to 97.9, which is a good thing for insurance companies. So the standard market's actually doing pretty well. Then we have the non-admitted market. You might have heard of that, or the specialty market. I'm going to call it the E and S, E for excess, S for surplus, the excess and surplus lines market. So you have the residual market, which is to the government, standard, which is the typical insurance companies who are licensed and admitted and regulated by the states. Then you have companies like Lloyd's of London, which would be considered an E and S market. So we have 3 different areas we're focusing on. Next slide. So let's focus on residual markets. Why do we even have them? And the reason that we have them is that the standard market is not willing to provide the coverage at the approved rates. When this happens and the standard market pulls back, then you see the state or the federal government create a program to fill the vacuum. They do this for social and economic reasons. Insurance is necessary for home ownership. Lenders do require that. It's necessary for economic development. Insurance is necessary for social resiliency so that communities can rebuild after a catastrophic event. So the question then goes to why is the standard market or the E&S market not providing the coverage? And one of the ongoing challenges for the last couple decades is that it's very difficult to accurately assess the risk. Back in the 90s, we really had no idea what our exposure was. It's come a long way, but still, the forecasts are not held in a lot of confidence. You can just look at the predictions this year for hurricanes. And knock on wood, we're late October now, and it's been a very mild season, which is not what the forecasters called for. So insurers need to have an idea of what's going to be the frequency and severity of hurricanes, how bad can it be, can they afford those potentially bad losses, how much confidence do they have in that forecast. Insurers do not like concentration of risk, which means they don't like to have a whole bunch of pieces of property in one location exposed to the same loss. They like the fire peril, where it's spread around the country, you're unlikely to see one large event affecting a lot of policyholders. Unfortunately, with hurricanes and the high density population on the coast, there's just a high concentration of risk. And when you add that to uncertain forecasts, insurers are going to require higher rate levels to entice them to provide the coverage. And typically that is at a level above what regulators were willing to approve. And so you have the insurers simply not provide the coverage or provide less coverage or start canceling and withdraw from the coastline. So the high rates are symptoms of this problem of being unable to accurately assess the risk. And hurricanes do a lot of damage. And the construction techniques that have been used don't do a very good job of resisting that damage. There's some really good science going on right now that is providing evidence of what construction techniques work and what do not, and that's the real long-term solution. But up at this point in time, the codes weren't necessarily as strong as they should have been, and even the stronger building codes were not being enforced like they should have been. And so the insurers have to be able to pull in enough money to pay for these uncertain events, and the only source they can get the money from is premium. It's not like the national flood insurance or the federal government where they can simply borrow more as they need to. They have to actually bring in money to pay their claims. Slide 4. So the insurers, we're not going to worry about them for the moment, how they pay their claims. Let's focus on how residual markets, how they pay for their claims. And really we're focusing on the big one. Or I guess it could be big ones. You could have more than one storm during a year. We certainly have seen that in Florida and along the Gulf Coast. Or you could have a series of medium-sized. But let's focus on what happens with the one large claim. So with the residual markets, we have a very large exposure that's been growing for the last several decades. When that exposure grows, it creates greater challenges to raising funds to pay for a big one. And the exposure is typically measured in a 1 in 100-year event. You could interpret that also as a 1% chance of a loss occurring this year. So it's certainly not perfect, but it does give a target for regulators and rating agencies and other entities, something to see. If we have this 1 in 100-year event occur this year, how do we pay for it? So coming up with a 1 in 100-year event is a challenge, but we have catastrophe models, CAT models. There are independent vendors out there in some states that have come up with their own models. RMS is probably the most widely used and well-known modeling agency. They will simulate different types of storms on the existing properties that are insured and see what the damage would be and assign probabilities to certain size events. The RMS model version 11 that came out a couple years ago, that actually changed the exposures quite a bit. Each time there's a hurricane or a storm, the modelers have new information. They refine their model, and then when it produces a new output, in this case with RMS 11, it actually increased the residual markets exposure quite a bit. There was a higher likelihood of inland damage according to the RMS 11 model. Now the RMS 13 model, which came out this summer, actually dials that back some. And so that's a good thing for the residual markets because now their 1 in 100-year event will probably be a little smaller, all things being equal, just based on the model exposure and prediction. And plus, you combine that with a mild 2012 season, and so far 2013 looks pretty mild. RMS 13 dialing back the prediction, and there's a tremendous amount of new capital coming into the insurance and reinsurance industry. These are all putting downward pressure on pricing, which should make it better for homeowners and legislators trying to craft a solution. So when we have this big one, when we get to the point where we have this 1 in 100-year event, how do we pay for it? It's paid through a combination of accumulated cash, commonly called surplus, assessments, either on insurance companies or policyholders or both, and reinsurance, and more commonly cat bonds. Cat bonds and reinsurance are very, very similar. With assessments, as I mentioned a moment ago, these can be on the insurance company, typically based on market share, or they can be passed on to the policyholder, typically a percent, 2, 3, 4, 5, 6, 7% of their premium, depending on what line of insurance. Might be just homeowners, might be auto, could be a variety of lines of coverage. The danger with over-relying on assessments is that a large assessment on an insurance company, when they are already trying to pay their own claims following a major hurricane, that can actually push them into financial difficulty. That was what was really causing market problems here in North Carolina several years ago. There was an unlimited assessment potential, and the insurers were pulling back because of that. If you put too much on the consumer, well, the policyholder is trying to pay their own premium, their own damage, and then when you tag on assessments, over time, it doesn't go away until the debt's paid off. It can be quite a while. So assessments have they have a use in this 1 in 100-year event, but probably should be relied on too heavily. If they are used, the formula should be clear, transparent, specified ahead of time so that the insurers and the consumers have a pretty good idea of what their potential liability is. Then if we move on to reinsurance, that is an international business. Reinsurers have a global perspective. They're based all around the world, United Kingdom, Switzerland, Germany, Bermuda, the U.S. They have a global perspective. So if something happens in New Zealand and they pay a bunch of claims over there, that can impact our reinsurance rates in the U.S. And rates do fluctuate quite a bit on the reinsurance side. They're not regulated. They're going to vary depending on the amount of capital that they have, catastrophes, competition, economic conditions. On the bright side, there has been a tremendous amount of capital from hedge funds, pension funds, sovereign wealth funds that have been directed into the global reinsurance market, and this is driving rates down. Many people are searching for higher returns than they can get on government bonds, and interest rates are so low, this is a pretty attractive option for them. And plus, from a diversification standpoint, hurricanes and earthquakes are not correlated with the stock market. So there's a lot of appeal for investors to put their money into reinsurance and cat bonds. So reinsurance costs, right now they're stable, if not trending downward. That's a good thing. They do change quickly, though. And so insurers need to be cautious about relying too much on what the rate is this year because they can't necessarily transfer that cost or savings onto the consumer very quickly. The insurers, their rates are regulated, and they do not want to drop policyholders unless absolutely necessary, and so they need to be more cautious, and reinsurers are with changing their rates. Reinsurers are, though, offering lower rates. They're offering multi-year coverage, which is unusual, and there's a number of entities offering catastrophe bonds, which compete with reinsurance, and that's leading to lower rates and more favorable terms. Slide 5. As far as broad industry trends, the rapid growth that we saw in residual markets from the 90s up to 2008 has slowed. Much of that is due to the economic downturn, especially in the second home market along the coast. Most residual markets are still growing, just more slowly. The RMS 13 model is going to make it look like the exposure is a little lower, even if their policy count goes up because of the modeling discrepancy. And it might also be that growth is slowing simply because all the exposed homes along the coast have by now been moved into the residual market. We are seeing some standard companies start to provide coverage along the coast again, really only for well-built homes that are fortified, good construction, verified good construction. And if it's in a coastal county, it tends to be on the edge away from the water. Really quick snapshot, I'm just out of time, around the country. Florida, we can't even go there. They're just unique with exposure and the scale of the problems. The interesting area is actually in the Northeast. Following Superstorm Sandy and Hurricane Irene, so far they haven't really experienced any significant market problems. They do have residual markets. I've spoke to the leaders of both the New York and the New Jersey plan. They're not seeing a real large uptick in applications. That the standard and the E&S market in those states are very competitive, and they seem to be functioning just fine. Here in the Mid-Atlantic, South Carolina, Virginia, as well as North Carolina, there's been some improvement from the insurance company's perspective on rate adequacy. Reinsurance coverage is favorable. The market is stabilized, and things are actually looking better. North Carolina had some reforms a couple years ago, which has really helped improve the situation here. In the Gulf Coast, I know they're still dealing with the aftermath of AHIC, Rita, and Katrina, and I'll let the other speakers touch on that. So in closing, if you're trying to fix the problem, the time to do it is before the catastrophic event. There's plenty of examples where following the catastrophic event, there's pressure on legislators to do something, and that leads to rushed, poorly designed solutions. You need to address this ahead of time. It's going to take political leadership and buy-in from stakeholders such as insurance agents, builders, realtors. It's a tough job, but somehow you have to balance the regional fairness and difference issue. In longer term, there needs to be effective building codes and adequate enforcement. there's some really neat things going on in South Carolina at the IAVHS research facility where they're doing some tests. And a lot of it is just luck and timing, too. There's some plans that are set up pretty poorly, but they have not had many hurricanes, and they look pretty good. There's been some pretty good plans that have been created by legislators that have had bad experience, and they look pretty bad. So that's, that's just part of it. And with the recent reforms with flood insurance, that's really going to complicate this because a lot of consumers are going to get hit hard with flood insurance premiums, which is going to make it more difficult to get the residual market premiums up as well. But that's all I have. I'm happy to take questions later.
Thank you, David, and it's good, a good presentation and hopefully educational for those that are participating today. Next, we'll hear from Representative Stephen McMillan, who's a member of the Alabama House of Representatives. Stephen?
Okay, good. Appreciate the opportunity. I'm going to share some of the things that we have done. A lot of this may not be new to some of the participants because some of our ideas and concepts came from other states. The next slide, please. We had a governor who, fortunately for us, had been a long-time property owner in our Gulf area. So he was very familiar with the problems and was personally affected by it with his insurance rate increases also. So as a result of his interest, he created the Affordable Homeowners Insurance Commission, and it was designed to deal with the affordability and availability issues. For those that may not be familiar, let me give you just a little quick geography. We have 2 counties in Alabama that have frontage on the Gulf of Mexico. Mobile County, which is one of our most populous counties, has an area in the southern part called Dauphin Island, which is a barrier island with all of the Gulf frontage in Mobile County. Baldwin County is one of the fastest growing counties in the state, and my house district covers the entire Gulf Coast, Gulf of Mexico. Every foot of the frontage in the county is in my district, so you can see I have more than a passing interest in what goes on. We had a difficult time trying to get much of any substance through the legislature because the insurance companies were somewhat hesitant, and because they immediately defined or described our efforts as those just trying to help the rich folks that lived out at the beach. When the tornadoes hit in North Alabama, it sort of changed the perspective a little bit, and we got more assistance statewide. But that has been a major holdup. Then we had a 30-member commission appointed by the governor. We held public hearings throughout the state. The commission was made up of people from throughout the state, industry representatives, legislators, and citizen interest. We held public hearings throughout the state, which surprisingly to us was somewhat poorly attended. Matter of fact, the best attended ones were in the southern part of the state. The northern part of the state had had the tornadoes, but they had not had the increase in insurance at that time. And I think that's probably what attributed to the somewhat, at least the impression the commission got was a lack of interest. The commission divided up and decided to pursue 3 courses of action. One was education and information gathering. Of course, that was part of the purpose of the public meetings. And then compiling and evaluating the options and best practices available not only in our state but others, and the models that might be available for research. And then we developed priorities and recommendations that we hoped would impact the insurance industry in a favorable manner as far as availability and affordability. Next slide, please. The committee was divided into 4 subcommittees, and I'll touch very briefly on some of the substantive recommendations that we got from those 4 subcommittees. If you go to the next slide, please. The Education Committee proposed the creation of an Alabama Center for Insurance Information and Research with priority objectives being to provide policymakers and consumers with information and education similar to entities in other states, and we got some good ideas from several other states who have created similar entities. They also are designed to assist with disaster and crisis management, and as the previous presenter said, to do it ahead of time and not wait until it occurs. And then we wanted to create a competitive insurance market using this mechanism, because what we had been told from the very beginning when our insurance problems first started is that the last thing we wanted to do is make Alabama a less attractive insurance market, or to appear that we were going to be hardlined and deal very harshly with insurance companies, that we should be promoting the insurance industry, not just rubber stamping what they want, but not doing anything to discourage them, and in fact doing things that would attract new insurers into our market. And after several years, that's starting to occur. We've had several new underwriters coming to the market just this year. Next slide, please. Excuse me, the education. If you'll go to the mitigation, please. Next slide. We have recommended through this subcommittee the adoption of uniform standards. That is a significant thing. Building codes in our state have been lax. Fortunately, our county government bodies in the two coastal counties have done a good job of recently adopting more stringent codes and enforcing those codes. The other problem we have in the southern part of the state, with the bottom two tiers of counties, is only not even half of those counties have a building inspection department, much less a building code, a stringent building code that's being enforced. We also would like to see programs to train and license contractors and code officials so that the insurance companies can be assured that if a building inspector in our county or our part of the state signs off on something, that it did in fact meet the specifications. We've got a way to go to accomplish that, but we are making some progress there. Another thing we wanted to do was have some mitigation grant programs, and we just coincidentally announced this morning a small grant program that we hope will be a pilot project for implementing other similar programs. Next slide, please. And regulatory somewhat, that subcommittee, a lot of the areas of work by the subcommittee sort of overlapped, and the regulatory subcommittee made some of the same recommendations as far as strengthening building codes and being sure that they are properly enforced, which is a big part of the problem. More emphasis was recommended from the Department of Insurance on consumer affairs and having a division that works with the citizens to be sure that they understand, know how to compare policies and those type things. Other recommendations that were made became law during the commission deliberations, and I'll share some of those. Next slide, please. Title statutory. We endorsed legislative passage of several bills from this subcommittee. Some of those had been previously introduced but not passed, and the consensus of the coastal legislators was that we needed to allow time for the impact of the already passed legislation before we tried to initiate any further legislative action. Some of the legislation that we had passed had provisions in it that the effective date would be 2 years after passage or something like that, to give more time for the department to develop the forms or reports and get them into the industry and that sort of thing. So there were other good reasons for not doing much more legislative action in this last regular session, which was earlier this year. I will say this, that as a result of some of the things that have taken place, and the insurance industry, I think, deserves a lot of credit, because they sort of got behind some of the legislation that we had previously introduced but had been unsuccessful in passing. And as a result of citizen pressures and assistance from the governor, the Department of Insurance, and as I said, the industry itself, and I'd like to think the involvement of the legislature was significant in passing some of this legislation, and I'd like to touch on some of the highlights of that. Next slide, please. Earlier, we had passed in Alabama and this was one of the significant bills, one of the few significant bills we got until the last couple of years. But we provided for the creation of captive insurance companies within the state of Alabama. Prior to that, we had entities like nursing homes, for example, participating in captive insurance programs, but they had to be domiciled offshore or in other states because we didn't have a provision under Alabama law for that to take place. Next slide, please. We passed the captive insurance law in 2006, and then in 2008, we came back and removed the prohibition that captive insurance companies could not provide personal motor vehicle or homeowners insurance coverage. Now they are allowed to provide that insurance in the state of Alabama. Next slide, please. One of the things we found out when we got into it is that we had never really codified or put in place the Alabama Insurance Underwriting Association, or AIUA. It was almost sort of a gentleman's agreement and a handshake with the insurance companies that were participating that they would do it and do certain things. They had plans, a plan of operation and articles of agreement and so forth. But none of that had been codified, so we passed legislation codifying all of those things. And it still required that any carrier members remain liable for their pro rata share of losses, and any carriers who were members but had ceased to be members still had the responsibility of bearing the pro rata share of the cost of any losses for policies that were written while they were members of the AIUA. And we also allowed them significantly to carry over surplus monies, because prior to that, the funds, profits or surplus funds had been distributed to the members, maybe not annually, but every couple of years. So there was no reserve fund and no incentive for the companies to have one because they were taxed on that. Next slide, please. Another significant thing that we did under the existing law at the time, surplus lines carriers had to meet certain requirements to participate in underwriting in the state of Alabama. And one of those things was that one of the requirements was that they had to have been in business at least 5 years in another state before they could even write in Alabama. And we changed that law and gave the Commissioner of the Department of Insurance the authority to waive that requirement if the assets were acceptable to the Commissioner. Next slide, please. This was referred to as a Property Insurance Clarity Act, directly related to suggestions and input and work from citizens. It required insurers to provide policy information to the Department of Insurance, but can only be shared after it's aggregated. It's confidential up until that point, and it breaks it down into details so that citizens can go on the department website and determine what carriers are writing in what parts of the state. Next slide, please. Another thing that was done was the establishment of a catastrophe savings account to allow homeowners to put funds into a savings account to be used for appropriate reimbursement of deductible expenses and uninsured portions of loss. It also allowed a tax deduction for those deposits made into that account. Next slide, please. We created an insurance fraud unit. This is something that has been tried for years, and we were one of the few states, if not the only one, I'm sorry to say, that had not acted on this earlier. We finally reached a consensus and were able to pass this, and it's been a significant contribution to the department's ability to have some influence over the industry. Insurance companies would not even turn in an agent that they knew or suspected to be a rogue agent because they were concerned that they would be sued for doing that by the consumers who have been taken advantage of. So those kind of things were clarified. Next slide, please. And then a homeowner's bill of rights, a lot of which came from the state of Mississippi, requires carriers to provide policyholders with an outline of the coverage and a comprehensive policy checklist so that they know what they actually are covered for. One of the things we found out is that consumers are not as knowledgeable about their insurance policies as we would like for them to be, and things that they thought were covered or maybe had been implied by the agent were covered, that they found out they were not covered. Next slide, please. So you can see what's happened with our AIUA, a tenfold increase in policies between 2004 and 2013. As you can see, total insured value in 2004, $330 million, and this year almost $5 billion. The types of policies, almost 100% residential, 60%, 66% are owner-occupied, which is interesting because we have a lot of second home owners. For example, we have about 16,000 condominium units on the southern part of Baldwin County, what we call Gulf Shores and Orange Beach and Fort Morgan areas, for those that may be familiar. Another interesting thing is that 81% of the residential property insured by AIUA are people who, homeowners, first primary homeowners who live and work in Mobile and Baldwin counties. And then the next slide, please. We, as a result of an order from the commissioner, have mandated premium discounts for meeting certain qualifications. You get a 10% discount for a house built in compliance with 2006 residential code, then 10% for a house that meets the bronze standard, which is primary roof construction and renovation, retrofit, and attic vents and openings. 15% for a house that meets the silver standard, which is basically the protection of the envelope, the roof, the exterior walls, and so forth, and the openings. And then 20% for the gold standard. That has to do with anchoring, the exterior openings, and so forth. And then 25% for a new house. Next slide, please. The previous presenter mentioned the Biggert-Waters Flood Insurance Reform Act of 2012. If any of the listeners have not familiarized themselves with that, I would strongly suggest that they do it, because it's going to impact the ones that will be impacted will forget there was ever a problem with wind insurance, because this is going to be a really hard-hitting thing for the insurance market. And I would encourage people, we've got a couple of websites on the last slide that will give contact information for the report from the National Association of Insurance Commissioners is the one I would recommend. Touch very briefly on the distribution of premiums. We're starting to see premium increases in the northern part of the state now as a result of the tornadoes. The next slide, please. The hurricane losses are not used by carriers in setting rates. They use a model. And the 2011 tornado losses were limited by the Department of Insurance, so that they carried less than a 1% weight at rate determination. Recently, carriers have been requesting increases closer to the justified rate increases, and that's probably from the tornado losses that the companies experienced. Premium increases for homeowners in Alabama over the last 12 months. Carriers have been granted rate increases ranging from 0 to 35% with an average of around 12%. Next slide, please. With exceptions, insurance premiums are fairly distributed across the state. There are some exceptions to that. The area of fire policies is one of those exceptions, and the territorial level of the rate changes is considered by the department. The state of Alabama has no authority to require a carrier to write homeowners policies anywhere in the state. Homeowners policies and rates must not be excessive, inadequate, or unfairly discriminatory. And that's the end of it, and I appreciate the opportunity. Look forward to questions. The final slide will give contact information.
Thank you, Representative McMillan, and we appreciate that detailed analysis, and hopefully the members of the webinar today will find it interesting, and we'll leave that up for a minute in case anybody wants to write down the contact information. Next, we'll have State Representative Todd Hunter, who's in the Texas House of Representatives. Good afternoon, Todd, and the agenda is yours.
Well, thank you very much, and The great thing about this seminar, it sounds like everybody has good Southern accents, so I'm glad to hear that. Let me talk a little bit about Texas. Texas has a little bit different situation, and the windstorm issue or the hurricane issue and funding has been around for quite a while. Let me give a little bit of a legislative 101 on our legislative process. Texas, the legislature meets once every 2 years. We meet for 140 days every 2 years. Within that 140 days, we have to get through a lot of agenda items. And windstorm, for example, is what I call a very, very discussed issue, but I'm not sure it's as well understood. But in our situation, we go through more hurricane seasons, basically, than we do getting into the legislative process. So you can go through 2 hurricane seasons and have 1 legislative session. And so sometimes we're playing catch-up, sometimes we're looking to the future on how to handle these things. I've been in the legislature twice. I was in 1989 to 97, and then I came back in 2009. I've been involved in the windstorm process, the catastrophe process, since those late 1980s, early 1990s to present. And basically, there is going to be another review of the windstorm and the hurricane process in the next session. But I'll have some comments, and I'll kind of go through some general information on some of the bills that we filed. And in this last session, we were there from January to May, and then there was a special session that took us into August. But we, on the House and the Senate, introduced certain legislation to look at funding. So let me first talk about some of the concepts that Texas is looking at for a future windstorm proposal. One of the bills that was introduced, and you'll see some slides on it, and they're known as HB, which is House Bill 2350. There's a 2351, and there's a 2352. And they'll be shown on your screen, but I'm going to talk to you about some of the variables that we're looking at. And you've heard from the other 2 speakers a little bit about the concept generally, the concept from their state. Some of the things that we looked at are a little different, but they're basically very similar in the theme. This time, the bills that you're seeing on your screen were actually created by a coastal task force. In Texas, there's 14 counties that are affected in the coastline, and they vary up and down the coast. We have what's called the Texas Windstorm Insurance Association, along with the Texas Department of Insurance. And similar to what has been told to everyone, the Texas Windstorm Insurance Association, which we call TWIA, basically provides coverage in the 14 counties. And generally the inland counties are able to get private market versus what we call the TWIA pool. This last legislative session, the coastal county representatives, and I mean people that live in those areas, came up with this legislation on the screen. And it was modified some in committee, but let me go through some of the general concepts. One, the coastal communities would like to see legislation that develops a new funding plan. And during this funding plan, they're looking at whether you're a 50-year storm, a 100-year storm, a 250-year storm. And we have to look at things that cover a 10-year storms, cover 20-year storms, and what we're trying to do is come up with a total amount that we feel secure, that will cover the liabilities, the structures, and basically the homeowners in those 14 counties. Right now, we're looking at different variables, and the legislation that's being referenced was looking at issues like bonds. What's the practicality of using bonds, pre-event, post-event? The issue also in Texas is, do you do an assessment on insurance companies? What is that assessment? Should there be an assessment? What would the percentage of the assessment be? We also were looking in the funding proposals about then what is the rate and the premium that would be placed into the windstorm fund by the actual policyholders, the premium payers. So from the funding, this particular bill was developed giving a formula, which I'm not going to go into a lot of specifics, but it came up with different formulas using those criteria. They'd also talked about funding for what we call Class A bonds. They also developed a funding plan for Class B level bonds. And we even went into a funding plan for Class C level bonds, as well as down to even a Class D. So the bottom line is, in the last session, we introduced legislation. It did not pass. It was discussed both on the House and the Senate side, but the proposals dealt with a funding plan using those criteria. In addition to just talking about funding, as the other speaker said, we also looked at if you come up with a windstorm plan or windstorm financing, hurricane protection, you also have to do things like provide windstorm resistance standards. And this legislation was trying to do things where you require certain residential construction criteria. We would grant coastal counties windstorm standard enforcement authority. And we would also, like on roofs and shingles, try to strengthen some of the criteria relating that. In any hurricane zone, you're going to always have claims. You're going to have some litigation. And that is also a variable, is to look at how you handle claim resolution. Another issue in Texas, because we are such a largely populated state, one of the issue on the pool, since it only covers 14 counties and many of the folks and the businesses cannot get insurance in those 14 counties, a lot of times people are placed in the windstorm pool just because they can't get private insurance. So one of the variables that we talked about in this legislation was how do you depopulate the pool so that you don't have it overcrowded to the point that it could get weakened. And different issues were talked about, developing a quota, trying to find a database, but the issue of depopulation is something in any state in the Gulf Coast area that has a pool is going to have to figure out how many insureds are there and how many are too much, and this is something that was trying to be addressed in the legislation. Also, the Windstorm Association, and this is an issue. The Windstorm Association has a board that oversees. One of the issues in the House bills is you have insurance representatives, you have agent representatives, you also have consumer representatives, the people that pay. And so one of the issues is what should be the makeup of the board, the decision maker of the pool that provides basically the decisions for those 14 coastal counties. And if you take a look at this legislation, there were different concepts where the board composition was appointed by the governor, and you'd have insurance industry members, coastal agents in there, inland members, actually financial industry members, engineer consumers, trying to provide a pretty good broad brush approach on protecting at least the value in the coastal counties. What occurred in the Texas legislature, because we have a short fuse session, House developed their legislation, the Senate, and we weren't able to pass a funding proposal this session. Now, right now, the Texas legislature will not go back into session until January 2015. That means we will be going through another hurricane season before we meet again. During what we call the interim, we have working groups, as I talk, trying to figure out a funding proposal that maybe we can get agreement on from industry, from different areas of the state, that we can then propose during the next legislative session. And who knows, if we could get an agreement, there might be some sort of action that could be looked at, maybe between now and when the session opens up in January. Now, what are the issues? You've heard a little bit, but in the state of Texas, I think some of the issues that we deal with when you talk about funding, you talk about having to approach this area, are pretty interesting. One issue that we haven't really talked about, but a lot of my folks are concerned, is the federal flood. You know, right now, as you hear public officials, you hear the consumers, you hear the carriers, I mean, rates for windstorm, I don't see but going up, and that causes a lot of consternation. But then you add to the element the flood insurance situation from the national to the state. It creates a new economic issue in any formulation of plans by our states in the coastal region. So one thing we're going to have to watch this year and next is how does the flood insurance issue develop. And I don't know about the other states, and maybe some of the panelists can address, but I've recently received calls by new mapping of areas based on the flood insurance formulas that are going forward. And that has people looking at the issue and wanting to know what's going on. Second, one of the big issues I hear when we talk about windstorm, we talk about how you would go forward, is remodeling and standards. I get a lot of people that say, hey, I've got stronger material in my house than what's being required, and I can't get approval to get certification for my windstorm insurance. So one issue we're going to have to clarify, at least in our state, is trying to set up clear and what I call common sense standards. We want materials, we want building to be up to standards, to be up to code, but we also don't want to be placed in a situation where people have to spend so much money that they can never get certification. The coastline of Texas is very, very important to our economy. And one of the issues I hear is sometimes we do policies, our state agencies, our pool become unfriendly. I mean, sometimes the only thing the coastal residents hear is how high are my rates this month. And so what I'm seeing is more of an interest to say, all right, if you're going to make changes, state agencies and pools, show some concern, show some attention, show some help on what we can do. My area, I'm in Corpus Christi, Texas. We really have not had a hurricane in the Corpus Christi area since 1970 or 1980, depending on who you talk to. We pay some of the high rates, and yet we haven't had a hurricane. And as one of the previous speakers said, you have tornadoes, you have fires, you have hail, one of the large property producers in this state. And so we get a lot of questions. Why are we paying these rates? Why don't we have a voluntary insurance market, especially when we haven't had a storm since 1970 or 1980? So we're in a situation where you're looking at funding, you're trying to be fair, you're trying to encourage, but you also don't want to punish so that there's no economy in the areas that you're trying to help. So we'll be balancing a lot of these things for the rest of the next year and a half and hope that we can, in Texas, come up with a very, very good proposal. The final comment is what we really need to do is, in the coastal zone, is to work not only with our consumer groups and our building groups and our real estate groups, but the private insurance groups to figure out how we can get incentives so that the private market does not dry up in the coastal zones. I mean, the best thing would be that you have competition between a pool and a private voluntary insurer. Right now, most of us in the coastal areas don't have that option. We generally have to go to a pool which is restricted coverage and many times high rates. So from the Texas perspective, I think there's a good faith effort being made right now to try to come up with a good formula. But I think the idea is let's come up with a formula, a funding pattern that's going to last, not that we have to do every couple of years. But I'm glad everybody's focusing on the issue. I'm glad our coastal regions are getting some attention. And I'm hoping that maybe from some of the listeners and the participants of this program that we kind of set the standard for where do we go from here, and let's do it in a constructive manner. And I'll look forward to the questions.
Thank you, Representative Hunter, and it's good to hear somebody that talks like the rest of us correctly. That being said, we have a couple of questions. The first two are for Professor Marlett, and one of them would be, David, a lot of states heavily depend on the reinsurance market in order to pay claims to the various policyholders. Could you comment briefly on the regulatory environment on reinsurance? In your opinion, is it adequate, and what do the states need to do working with their individual commissioners or with the congressional delegation if you think we need to move to a federal regulatory environment on reinsurance, especially since so many of them are offshore?
That's a good question. It's a complicated one. On one hand, the reinsurance industry is really not regulated. When the insurance companies obtain reinsurance, the regulators make sure that the reinsurance that they obtain is from a quality company and that they're financially sound. But the reinsurers themselves and their financial situation and the rates that they charge really are not regulated. So, how would you even do that? I think if you start going that route, you lose some of the flexibility, which really kind of makes the system work, because they need that flexibility to react from uncertain events, whether there's a hurricane or not, or interest rates are up or down, or capital's flowing in or flowing out. I think if you try to regulate it and put them in a box, it's going to become unappealing to investors to put their capital into the reinsurance sector. So that would be the downside. On the federal level, it would make sense to have some entity. And again, I tend to favor state regulation personally for many reasons, but I think with reinsurance in particular, it would make sense to have a federal regulator. There would be a single point of entry since it is such an international business. And that part makes sense. I don't think the federal government should be regulating the rates or the practices of reinsurance companies rather.
Yeah, I think the big issue is, are they solvent, and their solvency versus their risk exposure, and who makes that determination?
Well, the insurance company that purchases the reinsurance has an incentive to make sure that the reinsurance company is stable, because if the reinsurance company can't pay, the insurance company still has to. So, first off, the insurance company has the incentive to make sure the reinsurance companies are financially viable, because it's their money. I mean, it's an immediate impact for them. Rating agencies could look at reinsurers. I'm sure some are publicly traded, so you might have there, but I'm not aware of a governmental entity that is regulating their financial conditions. I don't know if the Europeans are doing it or not. I just don't know.
I know the U.S., the NAIC has looked at collateral requirements for offshore versus onshore reinsurers more so. I think that debate's still kind of evolving. Also, for Professor, we have a question, and this says, after 2004-2005, there was a big push to say that hurricane statistics had changed because of global warming. Thus, actual statistics were abandoned by people like RMS. How much is this global warming issue impacting reinsurance rates compared to the huge influx of capital into reinsurance? And that's submitted by Richard. Okay.
I attend industry meetings fairly often, and the issue of climate change comes up again and again. I think if you look at the public release statements from the reinsurance companies, they are accepting that the climate has changed, and going forward, we need to look at new data. And as you mentioned, the challenge is, well, how do we rely on historical data? And after 2004-05, people really were expecting a tremendous upswing in frequency and severity, But in reality, we haven't seen it. We had, of course, Katrina and Rita had a bad year here and there, but generally, it really is not. Florida hasn't been hit since 04, 05. But things are changing when we see Sandy and Irene hit the Northeast fairly close. So, yeah, I don't know how RMS in particular works their model, what sort of credibility they put on their historical data, but yeah, I think there is a consensus among the reinsurers that things are changing, and that makes their job more complicated. So when that leads to uncertainty, that just further increases their motivation for increasing rates. Because it's pretty safe to say if there's uncertainty, they're going to err on the side of being conservative and want to higher rates. Now, if there is this uncertainty, why are we seeing all this capital flow into the reinsurance sector? Because they must view this as a pretty good opportunity. Well, it's probably because there's not a lot of other good investment opportunities out there, rather than reinsurance being fantastic. It's just with low interest rates, there's simply not a lot of other options, and there's a lot of money out there, and they're trying to find a place to get a somewhat higher return.
Thank you. This is for Alabama Representative Steve McMillan. Steve, I think you covered part of this in your presentation, but the question is, are there any state-directed efforts in Alabama to encourage private insurance companies to issue coverage to property owners in coastal areas as a competitive alternative to Alabama's wind pool?
We've had discussions about using premium tax incentives. We don't have the authority to direct them to do it in the sense of ordering them to do it. One of the big problems is the insurance premium tax is the #1 source of revenue for the Alabama General Fund. So it gets back to that business about what part of the state you're from. The higher premium taxes are coming from the southern part of the state, but the beneficiaries north of the two coastal counties are not really excited about taking any money out of the state general fund for any incentives.
Okay, and then for Texas Representative Todd Hunter, and I think you may have covered part of this too, it also talks about the question, wind pool fund in Texas, like wind pool funds in many states, face enormous financial challenges, especially going forward. What is, in your opinion, what's the optimal way to bolster those financial stability of the fund?
And that's what we looked at all session, and I think it's a combination. The best way to have a good fund is a combination of trying to, #1, figure out a voluntary market incentive plan so that you can look at private market versus a pool. I think that it is important to look at a depopulation provision so that you don't overstuff a pool to the point that you wonder about the viability. I think that we have to come up with a balance on the amount of premiums that are placed on policyholders, because some of them are not, as the other panelists said, that wealthy. We don't want to overburden them with a bunch of premium costs that they can't afford and can't make their mortgages. But on the other hand, what we've got to be able to do is have a protection, through some sort of bonding program or bond pre-event, post-event, so that we're able to handle a storm if one that does come up. And the other issue is that I think that we need to look at is that we need to make sure, at least when we're doing remodeling, we're doing fixing of buildings in the commercial arena or the residential, that we don't put so many standards in that we're weakening what we're trying to do on strengthening the buildings in those zones for that area.
Okay. We are past the 3 o'clock hour, and I'm looking at my screen, and I don't see any other questions at this point in time. Are there any other questions that are coming in? Sujit, do you or the staff at CSG have any questions that I'm not seeing on my screen? Seeing and hearing none, I want to thank our distinguished speakers today for their coordination, and to all of you for spending this hour of your afternoon, Friday afternoon at that, with us. I hope you found the webinar useful, and informative. If you have or find other questions after we close, please feel free to forward them to Sujit, and he will do his best to get you an answer. If there is anything else that CSG or the Southern Legislative Conference can do for you or your state in your work, please, please never hesitate to contact us. And everyone have a great afternoon, and thank you.